welcome this Tuesday morning to India Market Open. Joining me is Tamanna and Agam as we gear you up for trade today. Tamanna, Agam, I think global markets are Decembering, holiday mode across world equity markets. Quiet, consolidating, we can call it whatever we like, but it is definitely a holiday mode.
But the Christmas mood is definitely in because global markets and at least US markets are flat but in the positive territory, and that's what we saw overnight as well. But the big story overnight globally is definitely what's happening in the Red Sea, and I'll come to that in a bit. Let's just start with the US market check. And Wall Street closed in the positive, upbeat mostly on Fed cut hopes. The best performance on the NASDAQ 100 overnight. Accenture numbers are out later today, India time, and that will be one to watch out for the India IT pack as well. Again, the big story, though, continues to be what's happening in crude, and that's because of developments over the last couple of days. The Red Sea is under siege, so to speak, because of attacks by Houthis. They're believed to be backed by Iran, and look at this as an extension of what was happening in Gaza and Israel. Because of that, a Norwegian ship was attacked. BP has said it will no longer ply its ships in the Red Sea. This follows a large number of carriers and shipping giants who have said they will avoid this route completely, and that accounts for about 60% of global trade. So not surprisingly, you saw a big jump in crude prices. They've paired off now, but Brent, for example, topped the $78 mark, and that's going to continue to be a pain point. It's an important story to watch geopolitically because the US and other countries are now going to create a task force to protect this zone. So watch that space for whatever fallout comes from there. The 10-year was, I would say, placid. It's remained below the 4% mark at 3.93%. So broadly, the cues coming in globally are positive, but like Samina said, definitely they are Decembering, and no doubt about that. The GIFT Nifty, they're looking like, in a slightly negative territory if I compare it to the GIFT Nifty close from yesterday.
You know, Tamanna, you mentioned that this was whatever's happening, the Red Sea has played out positively for bulls in the crude market. But the fact remains, every time we see crude inch closer to $70 a barrel, something or the other takes place, and you suddenly see the bulls back in action. Now, I'm not attributing this to any sort of theories I have, but it's interesting because you did see pressure off crude over the last couple of weeks, with no major production cuts expected. This morning, like Tamanna indicated, crude is back up and running. Unfortunately, because of events that are taking place in the Red Sea. That's pretty much what the global setup looks like. All eyes will be on Bank of Japan. Remember, if they are going to move away after many decades from a negative interest rate setup, that could be a huge positive coming in for the local currency there and would eventually impact risk on trade for some of the emerging markets. Well, let's take a look at what we're setting ourselves up for this morning. Of course, Agam will dwell more in detail on that, but it's been a quiet sort of day for our markets as well. Nifty traded in a very tight range in yesterday's session. Markets were showing some signs of fatigue. The bulls were showing some signs of tiredness. Except media and IT, most sectoral indices trade at their life highs. Another important takeaway from, of course, the data that came in after market close yesterday was tax collections have seen a pretty decent jump. So precursor to what we're expecting from the earnings season. If Agam bulls have to find a reason to move up, this might be one cue that we'll take from, because most corporates did indicate that this quarter was going to be a strong one, and advanced tax collections are all pointing in the same direction.
Yes, a lot of these factors, and of course we start getting your earnings expectations in a couple of weeks from now as well, which is likely to move markets. But over the next couple of weeks, we're not going to see a lot of action, and
it may not be such a bad thing.
It may not be such a bad thing. And
right.
that's something.
Agam, we'll have to interrupt you right there. I think
yes.
There's a mic issue that's happening, so we'll come back to Agam in a minute. In the meantime, Tamanna and we can discuss GIFT Nifty, global cues, and what's happening across other markets. Yeah, Tamanna, we saw it at close yesterday. The market struggled. It was in a tight range. Nothing significant to write home about. You had sectors like pharma, which did okay, but real estate saw immense amount of profit booking by the time we closed.
I I think it's going to be a very stock-specific kind of a day as well. Focus maybe on banks. Interesting report out by Motilal Oswal this morning on public sector banks, and some that they are definitely very bullish about. So you might see some kind of reversal there or some kind of uptick there on banks as well. But Agam, I think on the derivative side, what do you see the positioning placing up to? We saw a very tight range on the Nifty today. Are we going to continue to see that kind of a range-bound trade?
Yeah, so yesterday was, as I was mentioning, was one of the first days where we saw the first few signs of consolidation happening. We really didn't see the Nifty move too much. It was in a tight range, and when it comes to the positioning from a fund flow point of view, while we did see sellers in the cash markets, the FIIs have held on to their long positions with respect to their short positions in index futures, which still stands at around 60%. So not much has changed there. The Nifty put-call ratio, which was at 1.47 in the previous session, has come off, and it is now at 1.12. Now, that's a fairly neutral number as far as the put-call ratio is concerned. But remember that because of the fact that we've seen unwinding in both the index futures, is also an indication that we are seeing more and more traders who are, well, taking their bets off before we see perhaps a period of consolidation as we move into the final couple of weeks of December. What were the 2 or 3 sectors which stood out yesterday? None of them were frontline ones. Of course, media and pharma did stand out, did see an advance, but the Nifty Bank, of course, did come off as well. Longs unwinding there. We lost out on the 48,000 mark, and that perhaps is going to be something which is of importance, because below the 48,000, Bank Nifty moves into a range. And as far as the Nifty is concerned, at the moment, once again, if it slips below the mark of 21,000, that will also slip into a range. A tight consolidation is what the market participants are expecting, and below the mark of 20,700, 20,800 is where we could in fact see a change in trend. But that's really unlikely. That's going to happen at least in the month of December based on the kind of accumulation we have seen. And on the higher end, this one is an easy one to call. 22,000 is the level that everyone's keeping an eye on. Unlikely that we're going to breach that one. At least for now, it does seem like that, unless and until there's something which we see could potentially change the course of the markets. But we're not seeing any triggers, at least in the next couple of weeks. And yes, most likely consolidation happening over the next couple of weeks here.
Agam, a couple of other indexes I want to talk about. One is Bank Nifty. And towards the end of last week, we were pretty certain that 50,000 could have been achieved on Bank Nifty over the next few days. What are your thoughts on that? What does data indicate? And also the Nifty PSU banking index. Now that is showing signs of overbought. And I've seen across the board, advisors are saying move away from option trading, go into cash positions, be a lot more strategic about these indexes. On signs of being overbought, on signs of some selling pressure that's expected now?
Yeah, so Samina, that has already come through yesterday, because we've seen the PCR come off, and there's been an unwinding of nearly 8% in the Bank Nifty futures as well. So, well, there are a lot of traders out there who are taking profits off the table. And the fact that it's moved below the mark of 48,000, which was very, very important, it was an important support level, is now, well, that means that now the Bank Nifty slips into a 1,000-point range between 47,000 and 48,000. And that's how the picture is panning out as far as the Bank Nifty is concerned.
Yeah, well, that is Bank Nifty. It is showing signs of fatigue, like we've said. A quick check on GIFT Nifty this morning, expecting a flat start. So don't expect fireworks. Like we've said, global markets are quiet as well. Asian markets aren't doing too much. That's GIFT Nifty for you. Expecting a flattish opening in early hours of trade. Well, there'll be lots of stock-specific action, though, that will keep traders busy on the street today. One of the first few stocks I want to talk about is HDFC Bank. The reason this is significant is, one, because it's our exclusive, and secondly, they have been launched their first Maiden infrastructure bond. Remember, HDFC Limited is an infrastructure player, but post the merged entities, this is the very first time they've raised about 7,425 crore rupees via 10-year infra bond issue. The fundraise has come in the coupon coupon rate of 7.71%. Remember, bond markets have become have been the talking point now for the last few days. They have also improved of late after the RBI did not catch the market off guard in its latest policy statement, and of course the FOMC indicated that they would be anticipating or looking at cutting rates in the first half of next year. Apart from that, a decline in government bond yields, remember, makes it cheaper for firms to raise money through corporate bonds. This is coming at a range of 7.71, more or less on expected lines. It was actually in September that this merged entity was looking to raise long-term capital through infra bonds. Didn't go through because the markets then were volatile. HDFC is one of the many banks who have actually gone out to the bond markets to raise long-term funds. The other few that have done this in the last couple of months have been banks like Bank of Baroda, Union Bank, to name a few. So HDFC Bank, that'll be on the radar on back of fund infusion. Apollo Tyres, this one could be very active in today's day of trade, and Warburg Pincus seems to be most active in the Indian markets in the last couple of weeks at least. After selling a little bit of stake from Fusion Finance, they are expected to sell a 3% stake from Apollo Tyres and raise about $100 million. Noteworthy that they own about 8% stake in Apollo Tyres. Post this transaction, the stake will be at about 5%. The price that they're looking to sell is going to be at a 3% discount to yesterday's close price. Well, Devyani International could see a big reaction in today's day of trade. They have forayed into the Thailand market by acquiring 274 KFC outlets for 1,066 crores. They've done it through their Dubai arm, and Temasek is, of course, the partner for this deal. So remember, this business has been extremely active, QSR space in countries like Turkey and, of course, Thailand, and that's pretty much the kind of expansion some of these QSR names have been doing. So Tamanna, three big stocks. We'll watch out for them. Devyani will be active. Apollo may see some pressure. HDFC may not be market moving in so many words, but nevertheless, important development.
Absolutely. I'd add Sapphire also to that list, apart from Devyani, and news over there also on expansion plans, if you're looking at the QSR space. But some others which have news flows today. And just quickly, to just bring up before I go to a list of stocks that have news around them, I want to talk about what kind of fund flows we saw yesterday, where foreign investors bought about 413 crores. DIIs sold actually 33 crores, not bought. So we need to fix that. But we have seen a petering down of volumes, as we were talking about on the show, and that's probably going to pick up only in the maybe second week of Jan onwards, when you have more FII action coming in, and then the run up to the elections begins. But stock specific, Sun Pharma. Let's talk about Sun Pharma. They will acquire about 16% stake in US-based Lindra Therapeutics for about $30 million. That stock already had quite a run-up yesterday and crossed 3 lakh crore rupee market cap mark, so it was a milestone day, perhaps some more action priced in. And if you look at it over the last 1 month, Sun Pharma hasn't really reacted. Yesterday you had a bit of pharma action as a defensive play, but it's not been superb so far. I want to talk about India Glycols as well. They've received a 1,164 crore rupee order from OMCs for supply of ethanol broadly. All companies which are going to really benefit from the ethanol policy of the government should be on your radar, whether they're sugar companies making the ethanol, the companies which have to blend them, and of course OMCs, because that's going to be one big move going ahead. I'll talk about Nestle. Jan 5th has been set as their record date for a 1:10 stock split. So you might see some, response over there. Vedanta, the favorite for investors as far as dividend is concerned, they've approved a second interim dividend of 11 rupees per share, amounting to 4,089 crores. We'll have a more detailed report on that ahead on the show as well. And Keynes Technology, it has opened its QIP to raise 1,400 crores at a floor price of 2,499 per share. So that's a fair amount of discount to its current market price. But another important indicator to watch out is in terms of actual deliveries, and which stocks have seen those delivery volumes increase, Agam?
Right. So markets now from here on over the next 1.5 weeks is going to be about stocks, not necessarily indices. And at the moment, we're keeping an eye on IRCTC. We mentioned and we spoke about IRCTC, where we also saw a huge surge in increase in open interest. Of course, it's an F&O stock. But even in cash deliveries, we're looking at a 4.5 times deliverables as against its 1 month average, even as the underlying advanced by around nearly 13%. JK Tyres up 11%, about nearly 5 times in terms of its cash deliverables. Subex is the other one which has been in focus. Now, Subex is in fact gaining a lot of traction on account of a whole host of auto ancillaries which have also begun to move. Well, yesterday it moved around 9%, advanced around 9%, and that's where the deliverables stood at around 4.5 times as well compared to its 1 month average. And finally, of course, we have Team Lee's. This one is an unusual one because we don't really have a lot of volumes in general, and that was up around 8%, so naturally we did see a lot of traction there as well. This is where deliveries stood at around 6.5 times as compared to the 1 month average. So these are some of the names that we will be keeping an eye on as well as we move into trade today as well, and potentially expecting some more traction there. So that's as far as, well, all the stocks that we need to keep an eye on. But Samina, the primary markets, there's no letting up there. What's there? What's happening there?
Not at all. 12 IPOs. That's what we've been eyeing. You've got a bunch of them opening today. So just a quick mention. Of course, you can find more details about the same on our page. But I'll quickly highlight the 4 IPOs that will be opening today. You've got Happy Forgings, RBZ Jewelers, Multi Genes, Electroforce India, and Shanti Sprintex. So if you're looking to invest in the primary markets, those are the 4 on the radar for today. There will be a few more coming tomorrow, but for now the focus is on these 5 IPOs that are going to be in today. You've got 2 important listings tomorrow, which we'll talk about in tomorrow's Day of Trade, but you've got DOMS and India Shelter Finance that will be listing for the very first time on the exchanges. Well, that's pretty much largely the market activity that we're tracking this morning, but all eyes now, and I'm going to quickly toss it over to Alex for Editor's Cut. We have lots lined up. Alex, couple of stories that we're tracking this morning.
Absolutely. 3 very interesting headlines which we will seek to delve deeper into on the Editor's Cut. If you're watching this program for the first time, this is where we go beyond the headline and give you, hopefully, actionable insight that you can take into trade. The first and the most important question, I think, and this is a question, guys, that a lot of people are asking, is the Indian market overvalued? You saw foreign institutional investors sell for the first time yesterday in a while, 33 crore. That's a small number in the cash market, but is that indicative of more selling to come? How does India stack up to global peers? That's the question. The second point that we're talking about is the advanced tax numbers. And what does that indicate for the third quarter? Generally, that gives you a bit of a lead indicator as to what to expect on the profit numbers for India Inc. And finally, we'll talk about a headline that you already know about, which is the fact that Warburg Pincus, or an entity that is associated with that company, is going to be selling 3% stake in Apollo Tyres. Why now, at a time when the company is actually doing quite well in FY24? Let's start with the first question, Hiral, which is, how does India stack up? A 10% gain, I must point out, over the last month, 10% gain for the Nifty 50 approximately.
So if you see in terms of overall, if you have to compare India to emerging markets or even developed markets, Alex, clearly your current price to earnings, or if you take the 1 year forward as well, it's clearly telling you that India is expensive as compared to all of these markets. If you see the numbers that will come in on your screens as well, in terms of the performance, it's clearly indicating this. Now, the same numbers when we worked out back then in September, India was the 4th most expensive market, and now it's become the most. There you go. If you see the current P, which is at around almost 25 times. Similarly, if you see in terms of Sensex Bank Nifty as well, pretty much on similar lines as well. Let's compare this now in terms of the other markets from the emerging markets and the developed markets. If you see in terms of Hang Seng and Kospi, it's interesting to see how Hang Seng is just at 9.16 times, and that's the current, and 12-month, it's 8.47. So this is clearly giving you an indication where India is at in terms of the price to earnings multiple. Let's just quickly look at the US as well as the European markets as well. CACs and DAX, both of these, I mean, these are still smaller emerging markets, so you can't really compare directly, but this is just to give perspective in terms of where we look at. DAX and CAC, if you see in terms of developed markets as well, you have India, which is expensive from a current P perspective.
Twice that
as
mark,
well,
yeah.
exactly, it's twice. And if you see in terms of the US markets, now what's interesting in the US markets, Alex, is the way NASDAQ has moved, right? If you see the YTD performance, NASDAQ is up 42%.
Yes.
And I don't think so anyone is up beyond that 22% mark. So NASDAQ is clearly, literally, I mean, given returns which are way above what India or any of the other markets have given. So performance-wise, we're still not there. But from a valuation perspective, we become the most expensive now.
So 17.7% is the mark that the Nifty hit as of yesterday for 2023. So what you're seeing is absolutely on the dot, which is the Nasdaq is up 40% or over 40%. But the question is, can any other market around the world compare with that one group of stocks that has really been on a tear?
No, but Nifty as a whole, if you look at a long-term average, it's trading at 18.5 times forward earnings, which is in line with the 5-year average of Nifty, which is there. So it's so while Hiral is talking about, it's relatively overvalued, but the growth momentum is something which is of company, and the earnings is something which will determine the kind of valuation that a market will get.
So I guess to a certain extent, beauty is in the eye of the beholder. And do you anticipate that the potential justifies the valuations currently? Are you a buyer? You need to make
to this, I think, as Sajid is talking about the growth numbers as well, his next line of conversation becomes absolutely relevant to this.
Which is what I was coming to. Which is that the advanced tax numbers are generally a lead indicator of the performance of India Inc. And it's quite a positive number. Take us through those numbers.
There are two ways to look at the India growth in corporate India. On the top line, you see the GST numbers that gives you an indication of how the top line of the company is moving. And on the bottom line, you need to look at the advanced tax numbers. The numbers for the December quarter came in. And if you look at the 9-month period, which basically means that companies have to pay up to 75% of the total tax outgo by December 15th, they're growing at 21%. Which basically means that the profitability or PBT level, India Inc.'s PBT profit before tax is growing at 21%. If you break it down into quarterly growth, then you see in the first quarter, we started off with a slow growth of 17.7%. In the second, we went to 25%. And the third quarter, which is December end, as of the last data available, is 19.6%. So it basically means that you are looking at a good double-digit growth. But it also gives you an indication that there are some kind of pressure points coming in on the PBT level with respect to rising in some of the input costs, which is going on, or raw material prices, which are again inching up in some of the sectors. So that is showing up here in the third quarter numbers.
But can there be a direct correlation, Sajid, in the advanced tax numbers and the PBT level? The reason I'm asking is that in years past, you've seen companies front load their tax for the year, and so therefore they don't have a very big number in the fourth quarter. So can it be a direct correlation?
It is a direct correlation because what you are supposed to do is just project your profitability for the year and then pay 75% by the end of December. Now, there is a caveat here. We are a little myopic in looking at the Nifty 50 earnings or a Nifty 500 earnings. We are talking about entire economy here because the corporate tax collection is for the entire economy of all the companies who pay corporate tax here. So that tax collection is growing at a very healthy level of nearly 20%. So that is an important takeaway that there is a good growth momentum with respect to earnings growth is coming in.
Okay. And with this, one more thing I want to add is that if you see the overall advanced tax numbers as well, they're clearly exceeding your FY24 budget target as well. And to add to that, from a GDP perspective, we just saw a revision from a 6.5% to 7%. So all of this actually stacks up really well to what Sajid is saying in terms of that, yes, the profitability could be better. And this, in turn, will also reflect on your fiscal deficit.
Certainly.
Yeah. So there are.
I mean, the mismatch there is the divestment number, which Janani has pointed out in Delhi, and that's a very significant miss. To a certain extent,
so
this
there are certain things which will come in, like your Manrega numbers will come in. The food security, which has been extended by another 4-5 years, which has been there. So that's not been calculated as part of the initial budget estimates. So all those are taken on board. But the total revenue collection, which is in terms of tax, direct and indirect tax, is heading to meet or exceed the budget estimates.
So very good numbers, and also for the most important takeaway today, of course, is that yes, India is expensive, and as Sajid points out, the advanced tax numbers are indicative not just of the profits for the listed entities, but the wider universe as well, and that bodes well for India Inc. as a whole. But the last question has to do with Apollo Tyres. Why now? There have been a few sales by Warburg Pincus. Does this get seen in that context? The reason I ask is because Apollo Tyres on an earnings trajectory has been doing incredibly well in FY24.
Yeah, so Warburg Pincus clearly is not waiting for an improvement in profitability as far as Apollo Tyres is concerned. But so they're not exactly completely moving out. They're pairing about 3% stake. Their entity, White Iris Investments, holds around 8.04% stake overall in the company. And they're selling somewhere near the current market price, around 440 rupees per share. That's the floor price at the moment. I wouldn't want to hazard a guess as to why they're selling out, because one, they're not completely moving out of the company. Secondly, Alex, as you mentioned, that they are in fact looking at good growth in terms of their profitability. Are they keeping up to the peers? It's a mixed one, because while you have JK Tyres, which has seen staggering, stellar numbers through the course of the last few years, Balkrishna Industries, on the other hand, has done terribly. Apollo Tyres is somewhere in the middle. But where do they stack up when it comes to valuations? They're the cheapest at the moment, coming in at around 26 times. The most expensive, of course, is MRF, but MRF has a largely institutional holding because of the fact that it is such a largely priced stock, even per share. Besides that, we have, of course, TVS Sri Chakra and the likes. But Apollo Tyres is currently the cheapest. So one may want to think about why is it that they want to move out at this point in time, even partially. So that's a question that needs to be answered. And in terms of how the stock is done on a year-to-date basis, well, it's not done tremendously well. It's moved up around 38%, as against JK Tyres, which has doubled, as against something like even a Seat, where the growth has not been as staggering as Apollo Tyres, but that has also moved up around 49%. Balkrishna Industries has just moved up around 18%, but that is again on expected lines, because they've really not done well in the markets abroad. They get a lot of their revenues from abroad. So the question really is that as to why they're booking out at the moment. It may not necessarily have to do with Apollo Tyres, but perhaps Warburg Pincus and their portfolio
strategy.
overall.
But if you look at when Warburg entered, I think they entered into an agreement in 2020, and finally they got the shares in 2021. It was through CCPS, so the conversion price was around 171.5. So if they're exiting at 400 plus, they already doubled their investment, and they're booking some of the profits. So as Agam said, they're only selling around 3%. They hold around 8% in the company. So it's just some kind of profit booking that they're doing for their portfolio.
And then to add to this as well, if you see in terms of the tyre space, what's happening is you've seen JK as well as Seat, which are moving on the premiumization strategy currently, right? So that's the shift that they are taking. And to add to that premiumization, the two-wheeler space is what they're concentrating on. We heard about Triumph, we heard about Royal Enfield, we heard
Hero
about
Motocorp.
Exactly. So all of them, with their premium launches, it's mainly JK and Seat which have entered that segment. Apollo is stronger in the passenger vehicle segment as compared to two-wheelers, right? So from a strategy perspective, from a growth perspective, everyone's still betting on from the two-wheeler space, if you have to look at tyre ancillaries, and you still have Apollo, which is slightly lagging behind from a business perspective.
We'll have to see how the stock action is in just a short while. And in fact, those were the three big headlines that we talked about this morning on the Editor's Cut. Let us know what you think about them. And in the meanwhile, we have to slip into a very quick break. We're back on the other side with action from the F&O space. So do stay tuned.
Welcome back. You're watching India Market Open, and before we set you up for the F&O segment, let's just take a quick look at the top headlines at this hour. Global cues are fading, but investors are keeping their eyes fixed on the IT sector as they await Accenture earnings. Meanwhile, bulls cool their heels. They're ignoring rate cut pushback from various Fed officials and continue to remain in a celebratory mood. It's an NDTV Profit exclusive. HDFC Bank raises over 7,400 crores through INRA bonds, and the new telecom bill ignores objections raised by domestic operators, proposes direct allotment of spectrum. The government has reduced windfall profit tax on crude oil and diesel exports as well. Quick look at the Gift Nifty before we go across to Agam for F&O data and what the trade is set up like. We're looking like we're set perhaps for a flat start. And Agam, are we going to see that same sort of range-bound trade as well? You know, we've started the show saying that the market is Decembering. All segments of the market, I presume.
Yeah, that it's most likely to play out. But let's take a look at what's really happened yesterday and see how, in fact, yesterday was one of those first days where we saw a little bit of that range-bound move and consolidation starting to come through. Now, as far as the Nifty is concerned, marginal losses for the benchmarks, but unwinding in index futures to the tune of nearly 9%. The Bank Nifty futures, of course, also seeing unwinding to the tune of nearly 6%. But remember, the underlying has now closed below the mark of 48,000. The question is, are we looking at another bout of profit taking before we start seeing consolidation over the course of the next couple of weeks? But as far as the option markets is concerned, on the Nifty at least, we saw a little more writing around the 21,500 calls and puts. And where does that stack up, and where does the open interest distribution play out? How does it play out? At the moment, while we continue to see the 21,500 call as the one with the maximum open interest, we are seeing more and more accumulation around the 22,000 call. So that's around where we are seeing a lot more action coming through. And of course, on the lower end, a lot more writing around the 21,200, 300 and 400 puts. That gives us roughly a narrow range of around 200, 300 odd points. The question is, where do we go from here? But, you know, this is as far as the Nifty is concerned. Today is the Fin Nifty options expiry. As far as the Fin Nifty goes, once again, keeping an eye on the 21,500 mark. Now, we are expecting the Fin Nifty to perhaps close around 100 points within 100 points range, plus or minus around 21,500. Remember that options usually on expiry day for the Fin Nifty are very, very small. They're already substantially contracted, which is why, you know, even small spikes can in fact lead to a very large changes in premiums. That said, we're going to have to wait and watch as to how the Fin Nifty expiry does pan out. But as far as your open interest distribution is concerned, we have a lot more going on as far as on the call side as compared to the put side. That said, let's talk about stocks then. And we do have IRCTC, which is right at the top of the list, about a 13% up move in the underlying. A lot of longs building in there, along with Indiabulls Housing Finance, Zydus Life, and United Spirits. And in terms of stocks we saw unwinding yesterday, we did see about a short covering for Dr. Reddy's, Hindustan Copper, and Emphasis. On the other hand, Coforge and Hero MotoCorp looking at a bout of longs unwinding. So keep an eye on some of these counters. The question really is, what do we do with this data and where do we go from here? Let's get in an expert to answer all these questions. We have Shivangi Sarda of Motilal Oswal who's joining us on the show. Shivangi, good morning and thanks for joining in. Let's start with your assessment on the benchmarks. How are you viewing them over the course of the next 1.5 to 2 weeks? Are you expecting consolidation? Are you expecting moves? And how are you deploying derivatives here?
A very good morning and thank you so much for having me. So we've seen that, index has been touching life highs continuously, and congratulations to all of us for the indices to having, touched these levels. We've seen some profit booking yesterday, but then again, the support was quite intact. We've seen that 21,450 zones acted as a crucial support level. So this is some level that we need to watch out for, and the index looks quite promising even from these levels. We've seen a fantastic Santa rally, which is likely to, continue. Put call ratio has cooled off, which signifies that there is a room of upside over here as well. The FII's long short ratio is at 60%, which used to be 10% a month back. So it clearly shows that the infusion of the FIIs have been also very strong over here. Now, talking about the sector specific, even talking about Bank Nifty and the IT have started to participate. So these stocks have only started to participate. The others, have led the rally. So I believe there is a room for more upside over here till around 21,650, 21,750 odd levels. And of course, 21,350 would be a crucial support to watch out for.
We also have the Fin Nifty expiry. You did briefly mention about the Bank Nifty. For all those enthusiasts who like to play intraday and especially zero day to expiry, positioning, what would your recommendation be?
So we've seen that Fin Nifty moved in quite of a range of 100 points for major part of the session yesterday. And it's now, beginning to hold, but then, follow-up is clearly missing. So we need a follow-up action over here as the daily chart is taking somewhat of a pause right now. So momentum needs to continue so that it could touch 21,570 odd levels, and 21,200 would be a crucial support to watch out for. If the index holds, we are going for, buy on decline strategy over here. It is currently trading near its VWAP levels. So, the index is likely to remain range bound, but then, of course, some sort of a trigger in Nifty would aid the index movement in Fin Nifty.
Let's talk about stocks then, Shivangi. Right at the top, you have Hindustan Aeronautics. What's your view here?
So HAL is looking quite positive. As of now, we've seen that good amount of buying interest is seen over here. And the stock has recently, consolidated from the last 4 to 5 sessions, which just shows that there is a room for a more upside. It has been making higher highs, higher lows from the last 7 to 8 weeks. So clearly the momentum is likely to continue. And of course, we recommend a 2800 call near about 100 rupees with a stop loss of 70 and a target of 160 rupees.
Sure. And what about Exide? I believe you have a call there as well.
Absolutely. So Exide, we've seen that this stock is also one such stock which has, moved and participated in the rally. Supports are gradually shifting higher. It's trading in an upward sloping channel. Month-on-month basis, we've seen that the stock has given breakout and follow-up buying as well. So this stock, which has made a Poland flag pattern on the daily frame, is likely to continue and do well. So we recommend a 305 option over here, call option, with a stop loss of 6 and a target of 50.
Right, Shivangi, we'll leave it at that. Thank you so much for joining us, taking us through your views in the markets, and also giving us a couple of trading ideas. And with that, it's back to you, Samina.
Thanks, Agam. We've got Jay Thakur now, VP and Head of Alternate Research, Sher Khan, joining in. Jay, good morning. It looks like there's a little bit of fatigue setting into the markets. Bulls have taken a breather in yesterday's day of trade. This morning, as we gear up for trade, global cues are muted. What's the trade on the Nifty? Are you anticipating another morning of consolidation or a gap down?
Hey, very good morning to you, Samina. It's good to see you after long. And as far as markets are concerned, I would say that they have been now seems to be consolidating within a range of say 21,500, 550 on the upside, probably on the downside 21,200 to 300 range. We don't have still a lot of confirmation of a trend reversal, I would say, Samina. But Bank Nifty definitely seems to be facing clear resistance above the levels of 48,000. I mean, that is where we saw that it managed to climb above those levels a couple of times, but did not sustain above it. And we've been getting close below 48,000 levels. So I think that the financials probably are putting some pressure on the Nifty. Otherwise, if you see most of the other sectors, they're doing quite well. I mean, those which are not even performing, like IT, has now bounced back so sharply that the trend has completely reversed on IT, I would say, from now sell or down to up. So the overall medium-term trend has now reversed on IT as well. So the only part is the financials. I mean, Samina, if that provides a breakout again, or if that completes the consolidation quickly, I think the trend on the upside will continue to stay bullish, or the momentum will be back into the markets. Until that happens, I think there can be some consolidation, some profit booking on the higher side, but eventually we'll get some buying interest at the lower side as well, because the breakouts which has come, those are big breakouts, and hence I think that we will not see a major correction going forward in the markets.
So Jay, in that case, at what level would you initiate a fresh long position then? So if we do get a gap up of maybe 30-40 points today, we go closer to levels of 21,300. I just want to get the range. So if somebody wants to initiate fresh longs, at what range would that be at?
Great. So definitely, those who have missed out this rally, participating in this rally, definitely for them, I would say that, Samina, the risk reward will be favorable if at all we see Nifty correcting by say 2 to 3% at least. So when that happens, basically the stock corrects more, and especially those stocks which are high beta, so maybe they can fall even by 5-7%, maybe 8%. So that much of correction, I think, in the short term would be enough for the fresh traders or the investors to get again into the markets if they have missed out. So I think around the levels of 21,200 or 100, that would be a very good entry point in the market. But if markets don't fall, then what? Then I think that about 21,550 is where you will get a fresh breakout again. So it close around the levels of 450, 460. I think above 550 one can enter. Else one can wait for some correction to happen or consolidation to happen for entering into the markets.
Hi, good morning, Mr. Thakkar. This is Tamanna here. Great to speak with you on NDTV Profit this morning. I wanted to get a specific view from you on a few pockets. And let's start with PSU banks. They've run up a fair bit, and then we saw a breather over there. Notes out there talking about more potential coming in and the upside on PSU banks. Anything specifically that you like on the charts, and any specific picks that you have there?
Definitely, see, from the FLO segment, Tamanna, first of all, very good morning to you. And I would say that from the FLO space, definitely SBI. I mean, that's one stock, I think, which is a very clear bet on the long side as far as the PSU banking stocks are concerned. But then, focusing more on the non-FLO stocks, that is where you get the alpha, I would say, to achieve that in the Nifty PSU Bank Index. And I think among them, Bank of India. I mean, that is one very clear chart. Technically, I would say, fundamentally, too, this stock has been reviving quite well. And technically, we have seen a good rounding bottom pattern. We have seen a good falling channel breakout happening, a long-term falling channel breakout happening on a long-term momentum indicators. We have seen a clear bullish crossover. So my higher weightage would be on the Bank of India. I would say that it's trading around the levels of 112, close somewhere around those levels. Going forward in the medium to long term, I think it's inching towards 150, 175 as well. I don't think that now it should go below 85 levels. I mean, that's a very crucial support now going forward in the medium term. So you see, the risk is absolutely favorable out there. And from the FLO segment, definitely it's SBI. I think, from the short term point of view, one can focus on State Bank of India. It goes around the levels of 648. I mean, if you get around the level of 640, it would be a good entry point. One can place a stop loss at 620, target 670, 75.
Right, Jay, great perspective on those verticals. Give us a minute, we'll come right back to you. In the meantime, Jefferies has come out with a note on India equity. Himansh is joining us with more details on that. Himansh, what does Jefferies have to say?
Hey, thanks. So Jefferies has, the crux of the report is essentially that November slowdown that came in was much along the expected lines, and this was partly due to the reason, partly because of the fact that Diwali was spread over the months, the festive season was spread across the months of October and November, but the adjusted indicator was at 6% and it was in line with last year. However, the overall indicator was fell 2.9 percentage points to a 22-month low, which is a significant data point. Now coming on to the rural demand, that has been a key topic of discussion. Across indicators, only the two-wheeler recovery that we have been noting is the silver lining. Across other factors, you are noting a mixed trend. CPI is likely to rise on temporary benign global rates outlook. However, the softer crude prices do give some support to this. Broad-based indicators are relatively patchy, but power consumption has been showing a very strong trend in this pack. Consumption indicators showed a slowdown month on month, but the underlying trend is positive, and Jefferies is positive for a recovery that is going to be coming in the near term.
All right, thank you for that, Hemansh. I'm going across now to Gurmeet Chadda, Managing Partner and CIO, Complete Circle. Good morning, Gurmeet. This is Tamanna here. Great to speak with you on NDTV Profit. And I must say, your social media handles are very, very entertaining and informative. So we hope to see clips of this on them as well. Now, let's start with an overview of where we are on the Indian markets. Fantastic run-up. Everyone believes in the growth story. But the question is, are we now going into overbought territory? Are we looking too expensive? And after the maybe quiet next 10 days sessions in January, are you expecting another pickup? If so, what would be the trigger there?
So good morning. Thank you for having me. And it's my first appearance in NDTV Profit after the relaunch. So congratulations to all of you. I think markets, this is what market are. Yeah, they'll surprise you when you least expect. I think people are trying to lighten their positions before the state election verdict. And this is what I keep telling, and I've learned over a period of time, that if you miss the 5-7 best days in the year, your portfolio returns become very suboptimal. And that's why it's very important to be in the market if you're a long-term investor. Yes, you can take some of the calls of, having some dry powder in place, rotating between various sectors, because, rotation is very swift and fast these days. But you can't take extreme calls of being out of the market. So my sense is we are obviously on the slightly fair zone. I would still not call market expensive. So just be a little careful in, especially in the small and micro cap space where there's some euphoria in few pockets. I'm not saying entire small cap space is expensive. So you have to be a little careful. Don't pay 80, 100 multiples. And the other theory is that, if X stock has gone up, the other stocks should also go up. Because, let's say an X defense company trades at 80 times or 20 times EV by EBITDA, the Y should also scatter. I think this is where accidents happen. So you've got to be a little careful in incremental deployment. Slight contrarian approach will help. I personally think a lot of out of favor sectors may come back. So a lot of companies with oil derivatives as input, like paints, some bit of impact on other building materials can make a bit of a comeback. IT also, I think I would like to wait for the management commentary in Jan, although this quarter would be subdued, but I think the management commentary should improve as US economy outlook also improves. So if you have a slightly, patient view, you can stagger it over a 3-4 month period. I think IT offers, especially large cap IT, offers good risk reward. Thirdly, I also would urge investors that we'll see multiple rate cuts next year. Globally, there will be a lot of rate cuts. The 10-year yield in India has moved down from 7.30 to 7.15 as we speak. So there could be a softening in bond yields of anywhere between 50 to 100 basis points. So if you just buy a plain vanilla gilt fund or just buy DSEX, chances are you make 4-5% mark-to-market gain and 7% kind of an accrual. So there is some double-digit probably to be made in a bond portfolio as well. So be a little more balanced right now. We made good money. It's important to reset the return expectations at these levels and have a very balanced asset allocation.
That's such a valid point, right? Because asset allocation would have been impacted sharply in the last 6-7 weeks after the way equity markets have rallied. Now, help me understand this. If you have fresh money coming in at this stage, I know a lot of retail investors are feeling FOMO at this stage because, while there was a valuation call, there was risk management, this market rally came without any warning. How would you structure your portfolio? Would you go into debt for the next 1 year on hoping that you'd make some M2M there? There should be a rate cut like you indicated, so there could be capital appreciation. Would you bet on equity? And I'm asking you this because historically, debt has been an instrument which is more risk management as opposed to returns and generating alpha, right? But this time around, things are looking different.
It's a good question, actually. So, incremental money, as I said, be a little more balanced. So we always say it has to be goal oriented. So any short-term money, which is, let's say, 6 months, 12 months, I think should ideally go to the bond portfolio. Any medium-term money, which is, let's say, 2 or 3 years, you can slightly stagger it. Maybe a 6 to 8 week kind of a staggering would help. Have a little more bias towards large caps right now. I would not say, again, blindly only do large caps. So look at this way, for example, HDFC and Reliance put together is 26% of Nifty. That is possibly still at 18,000 Nifty. Most of the large cap IT is still down. That's another, let's say, double digit on Nifty. If you add ITC, you add HUL, you add some of the more names, Kotak, probably half of the Nifty is still available at pretty reasonable valuations. So have a little more bias towards large caps. At the same time, don't overpay. I think the accidents happen when you overpay for a stock. So there are a few themes which are still looking good within equity. I think energy is looking very, very solid and positive. I think this entire digital engineering and clean energy space. So there's a new age of engineering companies making way. We saw Tata Tech with a stellar IPO, which is a digital engineering company. There's a lot of action happening in traditional engineering EPC space, like the L&Ts of the world. We saw Siemens doing a demerger of the energy business, announcing it yesterday. And then there are the new age energy businesses and engineering businesses like Praj or MTR. So I think that space looks pretty good. I think the housing space still looks very good. I think the entire reality as well as the building material space, I think there are a lot of legs there for growth. So there are still themes which I think are very secular. And that's where but I think a staggered approach is better. And just use the dips. I think we are I personally think we are in a structural investment cycle. This phase could be very similar to 2003-07, and bull markets have very sharp corrections. So just make use of them, I think. But overall trend looks pretty positive to me.
Very quick follow-up on that, Gurmeet. Firstly, if I had to stagger my investments, what sort of a timeline am I looking at? The next 3 months, the next 6 months, the next 9 months? And secondly, what strategy would you play right now? Would it be momentum or would it be value?
So, I'm not very good at momentum. It also depends, there are different ways to achieve nirvana in stock markets, right? So all strategies have a lot of merit in it. I think the best, in my view, have a combination of both staggered and lump sum. So let's say you go for a 2-month, 3-month staggered approach. You may take advantage. Let's say you want to do a weekly transfer to equities, let's say 12 weeks. But if you get a 5%, 10% kind of a drop, move in early. I think you got to be a little more now, agile on the portfolio. That's number one. Number two, I think I would still think growth at reasonable price makes sense. So it's a little bit of a blend of value and growth. So look at this. The largest private bank today is available at 2 book value and 15 times earnings. The largest PSU bank today is available at 1 book and 9 times earnings. ITC, one of the, let's say largest consumption conglomerate play, is still available at 22, 23 times. So there's still value, and that value still offers reasonable growth. So I think growth at, reasonable valuations, in my view, makes a lot of sense. And there are a lot of pockets, which are exciting. Another approach we look at it is a look at sector leaders, right? So a largest depository today may not be a large cap. It's CDSL, it's mid cap. The largest bioenergy play, again, is not a large cap. It's again a mid cap, which is Praj Industries. The largest sanitary ware could be a mid cap. So go for sector leaders, go where there is valuation comfort, go where there are solid return ratios.
The question is, how do you pick and spot those newer stories where the upside still remains? We'll continue this fascinating conversation. Jay Thakkar and Gurmeet Chatta with us. But we'll take a very short break and come back. On the other side, we're also going to be speaking with Andrew Holland of Avendus Capital. We have a power-packed show today on India Market Open. Don't go anywhere. let's take a quick look at pre-open rates on the markets this morning, and looking positive at first glance, but of course we'll have to wait for these to settle. We saw a tepid day of trade today, so think of it this way: flat but positive. Most people in the mood to sit on the sidelines, perhaps in holiday mode or wait and watch mode. Is that going to persist today is the question. So we'll revisit those rates and see how pre-open has settled in just a bit. But meanwhile, let's just put the focus on one sector which really has a lot of buzz around it. Motilal Oswal has put out a fresh report saying public sector banks are well poised for a re-rating. Mihika is joining us now with all the details. Mihika, what are you picking up?
Yes, so Motilal has come out with a report. Now, it maintains a buy on SBI, Bank of Baroda, Indian Bank, Union Bank and Canara Bank, and a neutral rating on Punjab National Bank. Now, earlier in Jan 23, Motilal argued that the underlying improved earnings quality of the public sector banks were well positioned to sustain and deliver a 1% ROA, but it looked very aspirational at the time. However, the public sector banks have demonstrated significant improvements in their operating parameters, and the combined profitability of the 6 public sector banks under Motilal's coverage has improved to 91,200 crores in FY23 versus a net loss of 29,500 crores in FY18. Now, 5 out of the 6 public sector banks have achieved the 1% ROA mark, and select guide a 1.2% ROA in FY25. According to Motilal's forecast, the FY25 ROAs will remain around the 1 to 1.1% range, implying that there is scope for further upgrades. They've also estimated the FY23-26 earnings CAGR to be 24% for public sector banks versus the 19% for private banks, and they expect them to sustain the earnings traction on improved loan growth, control credit costs and margin stability. Now, there are various factors. The deposit growth has been sluggish in terms of the public sector banks for the last few years, but the last few quarters have seen some kind of revival, and Motilal expects the banks to benefit from their distribution network, from their strong geographical presence and the improved digital initiatives, and they expect a 10% CAGR in deposits over FY23, FY26. The banks are also well positioned in terms of liquidity, with the LCR of all the banks above the 100% regulatory requirement. Furthermore, with regards to margin expansion, there was a compression in H1. However, the public sector banks will benefit and show resilient margins in the coming few quarters because of the MCLR linked loans.
All right. Thank you for that, Mehka.
Okay, thanks for that. Thanks, Samina. I'll quickly jump in and ask Jay a quick view on metal, on Nifty Metal, and any metal-specific names, Jay, that you would look at going long on. The metal index has outperformed the benchmark. We've surged extremely well all through last week, and even this week, there's not been too much selling pressure emerging just yet. Still opportunity to go longs on the metal index or specific metal counters?
Definitely, yes. Samina, see, what has happened is the Nifty Metal Index after a long time has moved beyond the levels of 7,050, 7,100 levels now. And I don't think that those levels now will be broken very soon. The kind of consolidation which we have seen in the metal pack, in that sense, I would say the first half of 22. Since then, it was just consolidating within this range of 7,050, 7,100 to the lower side as low as 4,500. That's pretty big range, I would say, of almost 2,000, 2,500 points range breakout, which we have seen coming in this index after a long time. And we have seen the monthly indicators now really have reversed from sell to buy. That clearly indicates that the medium to long-term trend now seems to have reversed from sideways to up. Right, and hence I believe that 7,000, 7,050 going forward will be a very, very crucial support range for the Nifty Metal Index. Hence, there is a lot of opportunity, I would say, on the upside is likely to reach levels of 9,000 as well going forward in the medium to long term. Now, as far as stock-specific ideas are concerned, I would say that definitely Hindalco is one stock, I would say, which has also provided a very nice breakout technically from an ascending triangular pattern, Samina, and it has taken its multiple swing resistance of around 520. So from the investment or medium-term point of view, from the positional point of view, I would say that yes, Hindalco offers a very good risk reward. As on the upside, I don't see any major resistance coming in on Hindalco until its previous highs of almost, I would say it's as good as 630 levels. So it's currently trading at around 566, 568, and 630. And on the downside, if I say 520 is a very crucial support, you see the risk reward. That's very good out here. And one more stock I would say that is still authority, that is SAIL, has clearly provided a breakout, has come back into the momentum after a long time, and has seen a decent corrections. I mean, I would say from its highs. So this stock too now the way it has provided a breakout above the levels of 100. I mean, going forward is likely to inch towards the levels of 135, 140, with 100 being a very crucial support range.
Gurmeet, I just want to refer to the report my colleague Mihika just talked about and get the focus back on the banking space. The public sector bank counters have run up. Are you seeing more juice there, or would you veer towards more private sector banks, or broaden your view as far as the finance space is concerned?
So, we would stick with the top one or two in PSU banks, simply being that you got to be more tactical in some of the tier two PSU banks. You don't know when an accident hits you. I don't see that really happening. I think there are still structural changes working, but there is valuation comfort. So look at, for example, Bank of Baroda, 6 times earnings, almost book value. They're still guiding this year for, almost 15-16% kind of a growth, with retail book growing at about 20% and corporate book at about 10-12%. I was very impressed seeing their NII numbers last quarter, almost 10,000 crores. Good jump in fee income as well. And it's been a while, you've seen like 0.7, 0.8% kind of NPAs with adequate provisioning and buffers in place. So I think it's probably cushioned also well, provides valuation comfort. SBI also, after some negative news on Adani and some little bit of stress in the unsecured book, their Q1 was very soft, almost flat Q-on-Q growth, but Q2 was much better. They again came back to double digit, 3% Q2, almost 12% growth. Still guiding for 15-16% ROE with 1% plus ROA. Look at the kind of market share they have commanded in mortgages now, almost a market leader with more than 5.5 lakh crores, 30 lakh crore mortgage segment. Yono continues to do well. So I think I would place myself there. And then also, as I said, there's some comfort in HDFC and ICICI too. They haven't run up too much except for the little moves we have seen. But a little careful now on NBFC, especially with, ones with high unsecured book. It's not that I'm worried about more slippage. It's just that I think RBI will probably be a little more proactive. They are worried about low ticket personal unsecured loans. You'll probably see more, intervention there, other than just the risk weight addition they have done of 25 basis points to both PSUs lending to NBFCs and NBFCs doing unsecured lending.
Gurmeet, just moving away from the secondary markets for a minute, do any of these new IPOs interest or excite you?
I think the issue is that whatever interested us, we didn't get any allotment like Tata Technology. I think Inox also looks very, very interesting from a long-term point of view. But, IPO gains are short-term, and the kind of, oversubscription reduces to a point. I think the broad thesis being that look at good businesses. We like Tata Technology. I think that's one of the best IPOs which we've shown. We visited their Pune plant. Very impressed with what they are doing. It's a complete digital engineering company, starting from concept to mechanical engineering to embedded software to the complete value chain of automobile. Diversification across defense and aerospace. They recently added Airbus. We were very impressed seeing some of their, abilities to develop a digital cockpit. They are also capturing a lot of data inside the car, like, how much is the tire pressure, let's say, when you're doing a mountain drive, or what's the kind of fuel efficiency in different terrains. And a lot of that software data can be monetized later on. So very futuristic company in my view. Obviously, it doesn't give you a lot of valuation comfort at these prices. So this is one space we like, and we are looking forward to more such. The Inox is another one we'll probably have a look on. But we're not really investing for any short-term listing gains in IPOs.
Yeah, as tempting and delicious as those listing gains may be, the last few IPOs have shown that holding on might be a good idea. I'm going to quickly move on to an NDTV Profit exclusive story. HDFC Bank has concluded its first debt sale after its merger with HDFC yesterday. The bank raised over 7,400 crore rupees via a 10-year infra bond. Mimantsa has more details and context on the issue. So Mimantsa, as I understand it, this is short of their target of 10,000 crores.
Yeah, hi Tamanna. So yeah, HDFC Bank has raised 7,425 crore rupees through infrastructure bonds at a coupon rate of 7.7%, which is a little short of what they are intended to raise. That amount was 10,000 crore rupees, out of which 5,000 crore rupees was under the green shoe option. But the bank's first debt sale after the merger with HDFC has received 75 bids worth rupees 8,700 crore. So banks are pretty much optimistic on the possibility of an oversubscription, but also because the pricing is favorable for them right now. But that is not enough to entice investors as of now, as the experts have told us. As a result, some banks are not able to raise the entire amount. So people that we have spoken with, the experts' opinion says that the issuers want aggressive pricing, yes, and investors are looking for higher yields. Now, because the debt market is flush with bond supply from corporates, investors are rather cherry picking. So they are going for bond issues that are safer, that are more liquid, and also giving higher returns, which are the bond issuances by quasi-sovereign entities such as NABARD, IRFC, and more such organizations. So investors are now weighing in all their risks and returns before choosing to subscribe to a bond issue. But for the issuer, it is probably the best time, like I mentioned, that this is the best pricing that they can get right now, considering that the US Federal Reserve is not going to increase rates, or rather cut rates in 2024. For HDFC Bank per se, the fundraise is particularly crucial because they are going to replace the HDFC Limited borrowing. So it is expected that HDFC Bank will continue tapping, but how the response is going to be going ahead, that we'll have to wait and watch.
Mansa, so to just make this clear to our viewers, that it wasn't undersubscribed. The intention was with the 5,000 crore green shoe option, which part of that only has been exercised by HDFC, the new merged entity. They've talked about raising these funds since September. The markets then were extremely volatile, but with easing off on the 10-year yield, HDFC did take that initiative and actually go out and execute raising funds through infra bonds. Remember, this is long-term money. The pricing is pretty efficient. A number of banks in the last couple of months have been reaching out to the debt markets to raise funds. But Jay, we've got 2 minutes to go as we gear up for a quietish kind of day of trade. Anything exciting? Any top picks from your end?
Definitely, I have a couple of them. I would say, first I would talk about the F&O segment. From the F&O segment, I think that Samina emphasis looks positive. It has provided a very nice breakout, and emphasis seems to be heading towards the levels of 2750, 2785 in the short term. One can buy this, placing a stop loss below 2625. I've got a sell recommendation on Balkrishna Industries. I mean, it's trading at the levels of 2511. One can sell this targeting 2440, 2400, placing a stop loss at 2560. So these are the ideas from the F&O segment. And from the non-F&O pack, I have a buy on HFCL. I mean, the kind of breakout which we've seen from a symmetrical triangle pattern, this stock is heading towards the short-term target of 90. One can place the stop loss at 72. And one more stock from the F&O segment is on Deepak Nitrate. One can buy this targeting 2420 to 2450, and one can place a stop loss at 2230.
Jeff, a few of your stock picks for our viewers. There is going to be activity, but it will be restricted to stock-specific trades. The broader markets, remember, could spend another day consolidating in a narrow range. That's what we saw in yesterday's session. Remember, barring Nifty, IT and media, all other sectors are trading at their life highs. Sectors like real estate saw some profit booking and selling that took place on a lot of those prop books for funds in yesterday's trade. Today, of course, is a different morning. Stocks like HDFC, Sun Pharma, some of your OMC HFCs on back of crude price movement could be in focus in today's trade. But it might be a morning of risk-off trade, so we should keep that in mind any which ways, given the fact that, like we've said before, we're Decembering, so volumes as well are easing off, and traders may not want to go in with very heavy positions into the Christmas weekend. Well, that's pretty much what we have. A flat opening, more or less on expected lines. No fireworks in the first couple of minutes. Holding on to 21,444. But of course, you are seeing a little bit of weakness across Bank Nifty. We're sub 48,000. Not done a big breach of that. 47,800 odd is what we trade at. Second straight day running. Broader markets are outperforming the benchmark. And yesterday's trade as well, you saw mid cap and small cap index do much better than the benchmark. And it's similar today. Small cap index up 0.5%. Sugar stocks gave it its support yesterday. It'd be interesting to see what's driving the broader markets today's trade. Well, the benchmark itself is softening, so it would be not too naive to believe that we might trade into negative territory in the next few minutes. But remember, it will be a tri-train, so no significant levels of support are expected to be broken in today's day of trade. Let's pull up the breadth and the big movers on gainers and losers on the index. The breadth is positive, so you've got fewer stocks that are making a move downward as opposed to stocks that are actually gaining in trade. We did indicate that oil and gas companies would be in focus. ONGC this morning is your top gainer. So higher crude prices, some recovery coming in, crude trading closer to $78 a barrel is garnering well for ONGC. While it does well for ONGC, the downstream companies will be under pressure. So BPCL, IOC and HPCL are the three counters that will feel the pressure this morning on back of crude prices. To some extent, fair to assume that defensives aren't doing too badly. So stocks like Nestle are trading positive. ITC's got a marginal gain. Infosys, Power Grid, Axis Bank, Grasim, SPI are some of the names that are trading with a positive bias. No runaway rally. HDFC, if I can just quickly take a look at that, they've successfully completed raising long-term capital through an infrastructure bond. The stock is one to watch out for. On the sell side, crude derivatives are doing slightly weaker. Asian Paints is trading lower. Some of your auto names are down and out, and it's a mixed bag really for your tech players. But Tamanna on expected lines. It's a quiet morning, and I don't think anyone's really complaining. It's second day of consolidation on the street.
Absolutely, and Nestle also has set its record date for its stock split, so maybe you're seeing some action over there as well. But let's take a look at some of the counters which had news flow coming in, and I'm going to start with Devyani and Sapphire, two in the QSR space, which had positive news. So look at Devyani, up about 6.5% to 7% this morning. They've announced its foray into the Thailand market. They've acquired 274 KFC outlets for about 1,000 odd crores, 1,066 to be precise, for which they will shell out 341 crores. So Devyani has been doing pretty decently. Just Sapphire, because you had promoters pair stake, so we'll just see what's happening there. So not too much action, but Sapphire Foods sold about 33 lakh shares, which is 5.24% of equity. Keynes Tech, let me just pull up Keynes Tech and see what's happening there. So two pieces of news there. The QIP also opened to raise 1,400 crore rupees at a floor price is 2,499. Of course, your CMP is higher than that at this point, and they're also going to buy US-based Digicom Electronics for about $2.5 million. I just want to talk about Sony. That stock has been through so much news flow, and today the news flow is definitely negative. A newspaper article quoting sources saying that Sony might look at pulling out of the deal entirely. Now, this is a news report. I must qualify right now, but that entire will they, won't they kind of story flows through as far as that counter is concerned. India Glycols. Let's keep an eye on India Glycols and see what's happening. Look at that, 9% up in trade on an otherwise very tepid day. So definitely the market looking for those stories to bet on. And India Glycols has got an order, 1,164 crores from OMCs for supply of ethanol. We were talking about this in our stocks to watch this morning on Trade Setup. So if you tuned in, you would have got that story as well. Apollo is another one, and we took that up on our editor's cut as well. That stock up up about 4.5%. An affiliate of Warburg Pincus is seeking $100 million through a 3% stake sale. This was as per Bloomberg, and the floor price there was set at $4.40 a piece. Sun Pharma, can I pull up Sun Pharma and see what's happening there? Sun Pharma hit a milestone yesterday in terms of market cap, but they're also acquiring a 16 or 17% stake in Lindra. Not too much happening with Sun, but then, you see pharma come up as a defensive play that it did yesterday. KPI Greens is another one. KPI Greens and JTL, we'll just talk about a couple. KPI Greens opened up its QIP on the 18th, actually, to raise about 300 crores. That stock is down 3% now. The floor price there was 12.45, and JTL has approved raising 810 crores versus via issue of warrants, and also has approved raising up 500 crores versus QIP. So some of the stocks that are making news this morning, but Samina, what's also striking me is the number of companies rushing to the markets right now to raise funds.
Indeed, it is easy money, like they call it, right, in the unlisted space. That is, of course, chasing any opportunity that one can get. But what's also interesting is, and I saw this report, the biggest investments that were made by private equity players in this year has been restricted to the pharmaceutical pack. We will try and get more details on that as we go along. But quick mention, your oil and gas names are in focus. So while crude prices is playing out, you've also got that windfall tax revision. Now, I know this is automated usually, but worth a mention, it's come down to 1,300 rupees versus 5,000 rupees per ton, on back of which, like Tamanna said, the markets are seeking out any form of triggers to see some movement or activity. So your OMCs, all your oil and gas, really, ONGC, IOC, HPCL, BPCL are all doing quite well. The other one worth a mention, and I'm not sure if Tamanna picked this one up, was Devyani. The stock is trading positive. It's up with a gain of 7% expansion plans in Thailand through their Dubai arm with the help of Temasek is what's supporting the counter. Devyani is up about 7% in trade. You've also got Dixon that's not doing too badly. So some of those consumption names are keeping themselves together. You've got a 2.5% rally on Dixon. Apart from that, Lalpath Labs is looking good. Nestle we've talked about. KPIT seeing a marginal uptick as well. On the sell side, and I'll quickly just mention the top losers that we have of the Nifty 100 counters. Z is under pressure, so that's down 2.5%. Insurance companies are taking a bit of a break. Max Health is down 2%. IRCTC, after a very long rally yesterday, is consolidating with a cut of nearly 1%. So that really is the market setup. It's a quiet morning, pockets of interest, and that's what I guess is keeping traders active in the session. The Nifty itself is trading very, very flat. Gurmeet, I want to come to you on one basket that was showing so much strength and so much euphoria, and of course was very, very attractive as well, and that's the defensive sector. The momentum has been very strong, but I know, and you've said this before as well, that you've got to be very selective about this pack, right? While the euphoria is back on order wins, execution will tell the difference between the boys and the men.
Absolutely. And, there have been instances in 2003-07 where stocks went up on order book, but execution became an issue. You got to be careful. So, for example, in private space, L&T and maybe Siemens probably have that 11-12% EBITDA, reducing working capital days, reducing number of receivables. Others do not have. It's slightly in uncharted territory when you see that. Railway, for example, if you see Titagarh, they have now, the order book is 10 times current year's revenue. So that gives you comfort. Also, I think they've done a lot of backward integration now. So earlier the mobility was an issue. So they did a JV. There's some technology transfer as well as now a JV with RK Forging. So great orders on both Vande Bharat coaches as well as the wagons they do. Similarly, in HAL, for example, we are seeing a lot of export orders. Continuous upgradation in the existing fleet which we need. For example, we need 42 aircraft formations to take on. Let's say if we have a two-way war, we're still at 32. So there's a long way to go in terms of strengthening that. So I think some of the names have promise, but obviously they've run up also very quickly. And some of these orders are episodic, so the orders may get executed with different milestone payments over 5 years, 10 years. Etc. So my sense is a lot of good news and a lot of counters is already in the price.
Jay, I just want to come to you on the buzzer of this morning, Devyani, to just get your view on how you see this counter. It's already up about 6.5%. Do you see more upside?
Well, I would say, see, Devyani's chart history is very limited, I would say. But then, based on whatever kind of data is available, I would say that yes, in the short term today, it has provided a breakout above the levels of 190. It can inch towards the levels of say 204.5 in the near term. That much more upside can be seen in the near term, but then the overall uptrend will be confirmed only above the levels of 225. Once those levels are taken off, you can place higher targets of maybe 275, 300 plus levels as well. That's only about 225. In the near term, in the short term, I think that this bounce back, which is happening, is happening after a 5-year declining structure, post which generally we see a good bounce back, and that is what we call a retracement as well. So short-term retracement in Devyani is happening, which can help the stock to inch towards 202, 205. That is where one needs to really review that whether it will further inch towards 225 or not, else one can exit at those levels.
Gurmeet, I wanted to get your take on the IT pack. Of course, Accenture numbers will be watched this evening to see where the trend line is. But after an amazing run-up, you have seen a bit of a breather there coming in. Are there concerns about what Q3 is going to look like for this space?
I think the quarter could still be soft, relatively slightly better than what H1 has been. But so I think I would wait for the management commentary. If you see, for example, within large cap IT also, the stocks have behaved differently. So HCL, for example, has a very balanced portion of discretionary, non-discretionary spending. They have ERD, they're one of the largest ERD players, and then there is a software business. So that stock is already at 1,500, almost near highs. Then there has been weakness in Wipro and Infra because of the dependency on BFSI and management constantly revising down the guidance quarter on quarter. TCS has been more resilient. They still managed to grow. It's been in flattish growth, but they still managed to grow. So my sense is I would wait for the commentary to come out. My sense is you will see more AI-related deal announcements. Remember in COVID, we had all digital deals, right, when things turned. So as the US economy comes out, I think the Fed fears there could be a soft landing. That's why I saw the pivot in last FOMC. Suddenly, they spoke about 3 rate cuts, FY24, and that's where the yields also came down. So my sense is there's something which probably the Fed also knows now. And there would be softening rate environment. So you got to be a little more patient here. Mid-cap IT doesn't offer any comfort. Look at some of the names which are really good, like Persistent or LTT Services, KPITs of the world. They're already trading at starting from 60 to 80 times earnings multiple. But so probably good news is in the price. So large cap IT offers some risk reward, but I would wait for the commentary before taking the full plunge. Take a little staggered view.
It's all about staggering your investments, especially given the kind of run-up we've seen in the markets over the last couple of weeks. Thank you, Gurmeet, and thank you very much, Jay. It was great having both of you on our show today. It's a quiet day of trade, but nevertheless, perspective is always helpful. Moving on from there, here's an NDTV Profit exclusive. We learned from sources that Commerce Ministry is working on a new scheme for the manufacturing of very efficient ACs. Janini joins us with more details on this. Janini, what are you hearing from your sources in the ministry?
Good morning, Samina. As you rightly said, there is a new scheme perhaps on the anvil by the Commerce Ministry for super efficient air conditioners. Now, this is still in the draft project report stage wherein the government is looking for more partners, multilateral partners. And the aim is to sort of, bring in viability gap funding, R&D and capacity building for these super efficient ACs. Now, what is the potential really? As the global temperatures are rising, there's always a more need for the air conditioning industry. Particularly, the World Bank now estimates that the Indian AC market is going to be a 1.6 trillion one, with the right kind of manufacturing setup, and the investment opportunity could just take off from here. Now, if you remember, there's also a PLI scheme for this very particular, niche, the air conditioning market, called the PLI for white goods. And as of last year, we had 26 applicants, including some famous names like Daikin, Hitachi, Panasonic, Voltas, Blue Star, Dixon, Metube, and Havells. Now, it's very likely that even these would, be interested in participating in this new scheme, which currently the government is looking to gain more, multilateral partners. And like I said, this has immense potential. If we even look at, agri cold storage, there's only 4% of capacity that's being met at this particular point. So going forward, there is always, a big potential for this. And India is currently spending close to 1 billion forex on solely importing cooling materials. Components particularly. So we'll have to see how this goes. But like I said, it's still on the anvil, but something to be excited about.
Right. Thank you for that, Janani, there with that exclusive story. And, we're going to take a very short break. I just quickly want to pull up the Z counter. We're flashing that on our screens that Sony has said that they have not yet accepted the deadline, deadline extension that Z has mooted. That stock down about 3.5% in trade. We're going to take a very short break. We're coming back with a conversation with Andrew Holland in our studios. Don't go away.
Welcome back. It's a quiet morning. Nifty is spending some time consolidating just like it did yesterday. Trades flat, 11 points higher on the index, but it's in a tight range. Broader markets are doing better than the benchmark. The mid-cap and the small-cap index both trading slightly higher than the benchmark itself. We have with us a special guest, Andrew Holland, CEO of Avendus Capital, joins in. Andrew, we are living in exciting times. We go from a recession in the US to a soft landing, no rate cuts to more than expected rate cuts. Locally as well, we've moved pretty swiftly in terms of valuation concerns to India looks highly attractive. We seem to be better than the rest of the world. These are unprecedented times. How do you approach the markets?
Yeah, it's been, it's been a hat trick of good news, right? Before the state elections, we had GDP growth figures which were very good, and that was, again, confirmed with the RBI increasing its forecast for GDP to 7% for this year. State elections was much better than I think most people expected, so that worries about any kind of populism or not a stable government going forward were taken away. And then the Fed came with the full Santa Claus outfit on and gave us this huge U-turn. And I'm still thinking about why that U-turn. Is the data that he's seeing, which is going to be slower than, in terms of inflation or jobs growth, or the economy slowing a lot quicker? Or is it the fact that if you go back, if you remember when inflation was ticking up and he said, no, it's transitory, it's not going to, it's okay. And then he had to kind of raise interest rates, very aggressively. So maybe he's trying to front end this time in terms of getting rates down or the expectations of rates coming down instead of being late to the show again, which the market wouldn't like. So I know he said, 3 rate cuts. The market's telling you he's going to reduce rates in the first quarter of next year, probably by the end of March by 25 basis points.
Do you believe that as well? And in this whole conversation about a soft landing, about the US sort of averting any risk of recession, which emphatically everyone says no, where would you stand on that?
I'm not in the Goldilocks camp at the moment in terms of a soft landing. I don't remember a soft landing in all the years. The closest I think we got was after the 87 crash, when everyone said there's going to be a big recession. It didn't happen, but it happened 2 years later. So I think maybe because of COVID, the inverted yield curve is telling you there's going to be a recession. Maybe it's just been held back for another quarter or so, but it's coming.
I want to just get a sense from you on the whole narrative, and actually it's being backed by figures as well as far as the month of December is concerned, about foreign investors looking at India very, very seriously as an alternative to China, as a good destination for funds coming in for investments. Do you see that continuing well into the next year's Jan onwards, going to be exciting? And at these valuations, is India still looking as attractive?
So on the valuations part first, we've been saying for some time now that as we go into 2024, the multiplier effects of the government capex, private capex, is really going to increase earnings going forward. So I think we're going to see earnings upgrades going into 2024, which will probably mean the valuations are more towards the kind of normal levels at 17, 18, not the 20, 21 we're looking at the moment. So I'm a little more kind of okay with the kind of valuations at the moment, because we will see earnings upgrades. In terms of flows, everyone loves India, no one likes China. That can reverse very quickly. If China was to do a big stimulus which gave confidence to investors that the property problems are going away, then you could actually see that flows will go towards China. It's a cheap market. So, don't expect that all to be just, India only. And because China's in such a problem, you've seen emerging market funds lose funds as well. There's been redemptions. So that's why you saw some money coming out of India prior to the hat trick of good news that we've had recently.
In fact, markets like Hong Kong are actually negative 2023. So valuations in perspective, those markets look far more attractive at this stage. But let's talk about what happens going into next year. 2023 has been exceptional. The Nifty itself is up, 12-13%. Broader markets, the small and the mid-cap index is up anywhere in the range of 38 to 50%. As we go into next year, do you think this euphoria could continue? I've seen a few reports where they've said moderate gains. Don't expect any more than 2 to 3% in the next year, which also in a way is fair given what we are coming out of this year?
I'm a little bit more optimistic
Thank God
than,
for that.
than 2 to 3%. I mean, for this year we said we'd probably be in line with earnings growth, so around that 15%. So that's where we are. That's not a bad
number to
outcome.
be at,
and I think they're similar for next year as well. But we could be front-ended in that because obviously the first quarter you're going to get this expectation of interest rates falling quickly, and then you've got the kind of views about the elections, and so that first quarter you could see the Nifty kind of getting towards that another 5% from here in terms of an upturn.
Andrew, at this stage, if I had to ask you for a strategy, what are you betting on? Are you playing momentum? Because that's pretty much what the last few months have been about. Or are you seeking value in this market?
Value is always a difficult one. I think the way I'd approach this market for the next quarter, I'd be in large caps.
Okay.
I'd be in banks. I'd be in IT, and I'd be in metals.
I'm trying to understand what the India proposition is looking like, the long-term bet, and how it ties in to sort of policy vision. You move towards a developed nation. Is it the infra spends? Is the bet on consumption reviving, or is it purely on corporate performance improving on and on? And just if you can tie that up with the sectors that you've picked.
Yeah. So. If you're going to be a $5 trillion economy, whichever timescale you want to put on that, the banking sector has to be a lot larger than it is today. So, that will grow along with the economy, if not faster, than nominal GDP growth. So the banking sector is something which will continue to do well. If interest rates are falling, that pressure on NIMs will also kind of evaporate as well. So that's the great news for the banking sector. I think in terms of the earnings growth, as I said, it's a multiplier effect of all the government spending and the private capex, which will start to pick up now because you're running at, plus 70% capacity utilization. Companies will have to start putting down manufacturing sites and so forth. And of course, we'll have many companies come to India as well to take advantage of the growth that people are seeing. When you get, in my experience, having worked around Asia, is once you get past that per capita GDP of $2,500, you start spending differently. You bought your two-wheelers, you bought your fridges, you bought your microwaves. Now you want experiences, whether that's travel, whether it's coffee, whether it's alcohol. You start looking at different ways to spend your money and experience it. And we have such a young population, and they're all ready to do this. You can see it when you go out. People are experiencing more and more.
Does the sort of stark difference in consumption pattern across the geographies bother you, or do you take that into consideration at all? And let me clarify what I'm saying. The way people spend on discretionary items in your top metros versus just 100 kilometers out of them. Are you seeing that pick up, move in a secular trend across the country, and does it bother you that concentration will increase perhaps in pockets on discretionary consumption?
No, so I mean, there's going to be certain cities which will obviously have higher kind of expenditure towards luxury goods, but this affordable housing which has been going on, everyone's aspirational. They'll move up the ladder. They'll want, if I go to your home and I see something I like, I think I want something like that. And this is what I saw in the UK when Thatcher kind of gave the housing to everybody, but really, and that whole kind of boom came through. And I think it's similar to here. I think we're just at the very start of this kind of consumption boom in India, and it'd be across many different facets. But luxury and premiumization, I think, is something that we're going to be talking about for a long time.
So lots of aspects when it comes to aspiration, right? What does it mean for companies that play the ancillary part of real estate? So paint companies for that matter, wallpaper companies for that matter. Take that one step down to consumption. What happens to, I know you track wine very closely, and we will be talking to Rajiv in a few minutes, but what happens to companies, for example, like a Sula, or a Honasa, Mama Earth, or even a Nykaa? And that conversation extends further to the likes of a Zomato, right?
Yeah.
How do you approach this space? They haven't really made any money, significant money, if I may say. Do you think the next couple of quarters or the next few years belongs to these new 8 sectors?
I think it will be. I think you've now getting the volume going through these companies. We're starting to see a lot more kind of research reports saying yes, we're getting closer to the kind of profitability, and it's something that's not going to go away from us. I mean, we all use. If we want to get a quick meal at home, we know what we're going to do, right? And so, again, maybe not me, but the younger generation, this is what they're used to. They're not going to go out and say, okay, I'll go and wait at McDonald's and pick it up. They'll have it delivered. So this is the whole way of changing. And I think AI will change a lot of things as well. And I think there's a big change which India can encompass and do very well.
I'm going to quickly move out of a micro conversation to a macro conversation, largely because it's Avendus, right? And I want to understand from you, what is the reason of a lot of these private equity VC players making exits in India? So Warburg Pincus, for that matter, they sold a little bit of stake on Fusion Finance, they've exited Apollo Tyres today. And we've seen the likes of a Blackstone, check out a little bit of Axis Bank. Is it because if the outlook is looking so solid and we've got a strong earnings season around the corner, what is driving these international funds to make exits, especially when there is easy money around?
Well, I mean, you'd have to ask them, actually. I have no idea.
Industry perspective.
No, it's like everything, right? I mean, you will have your stocks. And
if you've made money, you get out.
If you've made money, you'll say, it's at the valuation of which I believe I should be taking money off the table as opportunity cost elsewhere in a different industry, which I'm starting to like. So, it's their strategy.
It's change of preferences.
It's their strategy. Maybe the fund, is coming towards the end of its life. There's many different reasons.
And there's distributions that could potentially be
talking about service-led and consumption-led sectors, I just want to quickly address the flashes that you're seeing on your screen. SpiceJet has said now in an exchange filing that it's expressing interest with the resolution professionals of Go First. It's wishing to submit an offer for Go First post-diligence. It's a brave move for anyone to try and buy an airline and revive it. We've been seeing what's happening with Jet, but SpiceJet is aiming to do it. We'll have to see how that works out. I just wanted your take, Andrew, on the whole mobility and specifically aviation space. A lot of reports recently saying that look at your passenger numbers. They're increasing massively. Fares are also inching up and stabilizing. Indians are getting used to paying a little more for your basic fares as well. But airlines are just not keeping up. Any commentary sort of on what you think about the space? And let me include airports in that pack as well.
No, I mean, if we think travel is going to be something which people do for experiences, and really the business side of this has not picked up. We haven't seen foreign tourists, it's not reached the kind of pre-COVID levels yet. There's a huge growth coming for the aviation industry, and of course that's great for airports as well. I mean, our airports are actually well placed if you compare when we travel overseas, and we have great
absolutely
great airports.
Mumbai, Delhi has really upped the game.
So I think let me put it slightly differently. We all complain about the hotel rates and from what we remember from before, right? But if we go overseas, you're paying a lot more for a lot less service than you get in India and Asia in particular. So I think people are getting used to, if they go to London, you're paying, we talked about it before, you're paying £200 for what you consider to be a good meal. Here people say, oh, that's quite expensive.
Yeah. But then you have to compare to per capita income as well.
Right. But I'm talking about the people who go to London and spend £200 are now saying, okay, I'm okay with it. I can do it here. And the food is good. It's not as though it's bad, right?
Yeah.
So I think, we're seeing a lot more new restaurants. We're seeing a lot more areas where we can experience and consume and have a great time.
One smaller sector, not small actually, a sector that we don't talk about a lot these days is specialty chemicals. These were the darlings of the street 3 years ago. How do you feel about it? Do you think the pain is coming to an end here? I mean, we're looking at articles on destocking, expansion. China, of course, is not causing any problems just yet for some of these players. What are the long-term prospects of the chemical industry? Still looking positive, you think?
I still think the jury's out, right? I think there's quite a lot of negativity surrounding it. Yes, they're cheap, but what's the catalyst to move them higher? I probably look at a new sector. One of the sectors we talked about before is the electronic manufacturing sector. I just think that's just, you know, if you take a an airplane out of the hangar, that's where we are. We're not even got on the runway yet for this sector.
Any specific stocks in that space that you like?
Can't really mention stocks, but there's
Market leaders is what you'd go after?
There's 4 or 5 of them which are listed.
And you like all 4 or 5?
I think all 4 or 5. We'll have, because they're all doing things slightly differently.
Yeah.
But anyone who's moving into semiconductors, is the whole AI play is going to work out for you.
I just want to circle back to what you said actually towards the start of this conversation, where you said you're liking large caps. You're liking large caps, and I want to put that in context of the kind of run-up we've seen in the broader markets. Small and mid caps have been the flavor for the better part of 2023. What is your take on, you know, smaller companies that look like they have potential to grow, some counters which are really looking like potentials of multi-baggers? Are you interested in those areas? Are you pulling back relatively compared to the kind of run-up we've seen this year?
No, so if you take the kind of 3 areas which we talked about, one is travel and hospitality, one is beverages in terms of premiumization, and the third is electronic manufacturing. Those, you know, kind of number of small and mid-cap companies in there. If you take the electronic manufacturing sector, they're all growing at, for the next 3 to 4 years, as far as I can see, 50% compound.
Oh, wow.
So, you know, what you're looking at now as a PE, 5 years down the road would be, you're saying that was a cheap stock.
That was a cheap buy.
Yeah.
Right, Andrew, give us a minute. We've got this exclusive story and we'll try and get some more details on this. Reiterating that NDTV Profit exclusive has been confirmed. SpiceJet expresses interest with Resolution Professional of Go First. Vishwanathan Nair, who joins us on the phone, is more on that. Vishy, what are your sources telling you? We've confirmed an exclusive here, I believe.
Yes, Samina. So we reported yesterday that SpiceJet is one of the interested bidders for Go First under the insolvency and bankruptcy process. Now remember that the bidding time had already ended by the time SpiceJet reached out to the resolution professional with an interest in investing in Go First. So now SpiceJet has come out to the market and said that they are actually interested, and they've reached out to the resolution professional. They've also done a fundraise recently, about $270 million, which will be used for the company as well as funding any growth plans that might be there for SpiceJet. Remember that SpiceJet itself is under a lot of stress. In fact, in the recently released results, they've said that some of the vendors have approached the NCLT for insolvency proceedings against them, and SpiceJet is fighting that in court. So it's interesting to see that SpiceJet, which is already a stressed air carrier, is looking to buy another stressed carrier. We have to see whether the lenders actually agree to this plan, whether they're interested in entertaining SpiceJet's offer. That will become clearer in the days to come.
Absolutely. Thank you for that. It was a story Vishwanath Nair broke on NDTV Profit. We're seeing the confirmation over here, and we will be following up with more details. But we're taking a very short break. We're continuing the conversation with Andrew Holland, but also joining us will be Rajiv Samant of Sula Vineyards, where we talk about the company's growth and expansion plans. We'll also touch upon premiumization, the trend we've been chatting about here at NDTV Profit. Stay tuned. watching India Market Open, and we have a very special segment on the show now. We're joined in studio by Rajiv Samant of Sula Vineyards. Of course, Andrew Holland also continues with us, and we're hoping to have an excellent conversation about the trends in this market, in this space. Rajiv, first of all, welcome to NDTV Profit.
Thank you, and congratulations to all of you.
Thank you, and thank you so much for coming into the studios today. Absolutely fantastic. Now, Rajiv, like I was saying before the break, you are the OG of introducing a domestic superb quality wine to urban Indians well before a lot of varieties were available. So kudos for that.
Thank you.
I want to understand whether the premiumization trend, which is there in so many discretionary industries, is being seen in a big way for you as well.
We've definitely seen that in a big way. Not only have we seen it, but Sula has really been pushing the whole premiumization trend. So, in the last decade or so, we launched specifically 2 new brands which are at the luxury, well, not luxury, but premium end of the market, which is our Source range and our Rasa range. And the growth in those brands has been much faster than the overall growth of the market. So we are definitely seeing it. We're seeing a lot more people. When we started out, our wines, the sweet spot was around 500, 600 rupees. Today, it's more like 1,000 rupees, 1,100 rupees. So that's happening in a big way. Now, whether it's going to continue at the pace that it's happened over the last couple of years, not exactly sure. We are doing our best to ensure that happens. But definitely today, there's a huge market above 1,000 rupees for wine.
Rajiv, what is the expectation of this festive season? We're coming in at a very good time. Markets are looking really good. The sentiment is up and about. Andrew and us were talking about how things are actually looking up for the country. How does that do for wine?
So I must say that when we look at wine, we're talking about a really long story here. We're talking about a boundless opportunity and endless opportunity. Quarter to quarter, is a different kind of a ball game when you look at wine. Diwali has been possibly a little bit slower than one would have expected, and I think you see that across a lot of consumer industries as well. However, having said that, we do expect another strong quarter. There's still a couple of weeks. These are the most crucial 2 weeks of the year for us that we've just entered right now. But we're hoping that we won't disappoint once earnings come along.
But you had a pretty good Q2. You had a pretty good Q2, all things considered. And is your outlook also over the next 6 months looking positive, double digits on your EBITDA PAT coming in for sure and going stronger?
I hope so. Look, I want to point out that it's not only Q2. We have now delivered around 6 quarters of record-breaking quarterly sales, margins, and profits. So it's been a great trend for us. And, that's the kind of trend that I certainly hope that we should see moving forward. That's what we are going to try to achieve and what we're going to try to deliver to our shareholders.
So we have Andrew Holland in our studios today, someone who tracks the company also pretty closely. Andrew, do you have questions for Rajiv?
Yeah, I do. On the hospitality side, which has been growing, I mean, we can never be able to book a room at Sula. I believe you just acquired or taken over another 30-bedroom hotel. Just tell us about that. How big do you think that will be for you in the future?
The hospitality is so important for Sula and for wine in general. I spent some years in California, formative years, and the one thing I realized there was that wine goes hand in hand with hospitality, the good life, beauty, aesthetics of the vineyards, etc. And so I was determined when I started Sula, the first thing that we looked for was a beautiful property that could be developed into something which becomes almost a pilgrimage spot for people to come and try wine for the first time. So I'm so happy today that Sula is possibly the most visited vineyard in the world, where more people probably taste their first glass of wine than any other place in the world. So it's extremely important for us from that point of view as a long-term growth driver in making people, taste wine and feel comfortable with wine and become our brand ambassadors. So, over 3.5 lakh visitors. Now we have over 100 rooms there at our Nasik property. We have plans to develop our Karnataka property. We are right outside Bangalore, just off the Bangalore-Mysore highway. So another great opportunity for us. And I really see the sky's the limit in terms of wine tourism. And as you say, there are many weekends where you still can't get a room.
Yeah. And in terms of, I think you mentioned you're looking at tier 2, tier 3 cities. Is that something that you've, what's the experience so far?
Yeah, very much so. So we're just scratching the surface when we come to wine tourism. At this point, we've just been developing our own properties. However, obviously the next phase has got to be to move out of that and bring wine closer to exactly where you live. So that's really on the anvil, some plans to be announced fairly soon.
And sorry, last question from me. So, you're the leaders, and there's a lot of obviously other wine companies which may be struggling a little bit. Any further thoughts about consolidation? Any acquisitions in mind? Any diversification in mind for you?
We are always looking out, and it's always on the table for us. At this point, I must say that at this moment, we don't have a specific target in mind. Having said that, as you said earlier, we acquired York, which was just down the road for us, so a very natural acquisition, and that's a much smaller operation than ours. And we are always looking out for other wine brands, but nothing at this point in terms of beer and spirits. We're just going to concentrate on wine.
Rajiv, I'm going to play a little bit of a devil's advocate here, right? While I know things are looking extremely positive, there was a recent study that was published that Gen Z is all about abstaining from alcohol. So after the millennials, if you've got a chart out of the future, alcohol is not their thing anymore, right? Are you looking, and of course tourism is one space that is going to be contributing heavily to your top line. Anything else, any new product launches, anything that's a little bit of a cusp, a mix, which is not really wine, but wine, or non-alcoholic beverages on the anvil? And then that brings me to the next question, inorganic expansion plans.
So Samina, I must point out that so much of this media hype and all of this news flow comes from the US.
Yeah. Now, we're still behind the curve.
Yeah, so when you talk about India, we have a long way to go. Okay. I have good news for you in that all successive and new generations coming up are drinking more than the previous generation in the cities, which is the important market for us, right? At this point, we're really very much an urban brand. It's going to take time for us to move into the villages. So that's not something I'm worried about. India has the highest number of teetotalers by far of any country, or probably as many as the rest of them put together. So, there's only one way we can go, and that's up. Having said that, yes, it's very important that we look at different formats, etc. We are the pioneers. We've been the pioneers in so many things. We launched India's first wine in a can about 4 or 5 years ago. That was our Diya range. And I got to say that we've got it's been a very successful offering for us, and we've got some more products in cans that works very well with a younger audience in terms of fridge space in India, in terms of sitting on your couch watching IPL. You want just a simple format, cold chilled can, just like beer, just like a soft drink, and we've got a lot of other exciting stuff happening as well.
Innovation, I think that's going to be key to keep the
very new product development, very important for any company like ours, always happening.
Just break it down for us on top line. What percentage of your top line comes in from premium wine? What percentage comes in from tourism? And what's the outlook in terms of growth parameters that we're looking at?
So tourism, when you look at including the wine, so you won't find this in the P&L, you have to sort of dig deeper. We're coming up to around 16 to 18% of our overall revenue this year is going to be on wine tourism. So that includes, room revenue, etc., plus the wine that we sell on site. That's the most important thing for us, because we sell our most expensive wine, and that's where really people are getting to taste it. That's what, and in the remaining 85% or so, today something like 65-70% of our revenue is coming from premium. And 4 or 5 years ago, that was probably just about 50%. So there's been a huge shift at Sula towards the premium end of the range.
So I just want to understand that on the tourism side of it, are you looking to up that as a proportion of your top line? Any plans over there? And when you're saying that more Indians and younger Indians are drinking alcohol and not really abstaining, but are they drinking wine? Because you have a gin rage right now, tequila is back, so people are drinking, but then there's always a flavor of the season.
See, when it comes to wine, we have possibly the lowest per capita consumption of wine on planet Earth, right? So less than 1% of alcohol bev consumption today in India is wine. We, on the other hand, we have the highest consumption of whiskey, not per capita, but the highest consumption in absolute terms of whiskey on planet Earth as well. So there is, and we have the highest number of teetotalers, as I said. So there is huge opportunity to, convert, you can say, teetotalers to drinking wine at this side and whiskey drinkers. So your daddy drank whiskey. That means most probably you don't necessarily want to drink whiskey. You want to drink something different. You're going to choose tequila, you're going to choose gin, you're going to choose wine. But wine is something, especially for women, which is probably the most compelling, and that's very exciting for us.
So in terms of, we've seen FTA with Australia, and there's talk about the UK, Europe. How's that changing the industries? I know it's more at the premium end in terms of those imports into India, but is it expanding the market? How do you?
It will. I want to point out something. If you just look at your own experiences, your social experiences, you're going to find that today there is no party and no event that's complete without some good wine being served. And a lot of people that you know, which is very different than a decade back, will go up to the bar and say, which wine are you serving? And they're going to make their decision on what they're going to drink socially that evening based on the quality of the wine being served. We've come a really long way. We've come to a place where you cannot have, in certain social echelons, you should say, a party or an event without good wine being served, which was not the case just a decade ago. You could have spirits at the bar and you'd be done. So there's a huge shift. In terms of things like gin, tequila, all of that, look, these are exciting times for all Alcobev. I'd say that India is the market for the future. So it's very exciting for us leading the wine revolution in India. We have 20 years of hopefully, good growth ahead. It's our job to deliver double-digit growth now, and we want to deliver that in tourism as well.
No concerns, Rajiv, about regulation?
Always concerns about regulation.
A lot of states want to, and some have banned alcohol. Others always, you see these in election manifestos, want to ban alcohol. Is that a concern on the horizon? And regulatory pressure, are you feeling that?
So regulatory obviously is very important in terms of Alcobev, and wine is no exception to that. I must say, though, the good news is that in the last couple of years, coming out of COVID, there have been more regulatory tailwinds than headwinds. COVID was very difficult. You can imagine, it was a disaster for Alcobev, including for us. So many states, the whole country, there was a ban on alcohol for some time. Then states increased taxes to make up for the loss of revenue in other areas. All of them have started moving back now the other way. And you have a more enlightened regime in place in several states, of course, Alcobev being a state subject, where they are looking at wine and beer separately from spirits. That's happening more and more. So it's been good rather than bad on the regulatory. Again, I say it can only go up.
Yeah, it's not constituted or labeled as hard liquor, so perhaps that helps.
It does still come in certain states under price controls. That's always an issue. But having said that, we're still able to get price increases through pretty reasonably. So.
Any sort of cost pressures that you're currently witnessing?
I'm really happy to say that wine has probably faced the least cost pressure in the last 3 years of any Alcobev. And that's because our grape prices, which is our main ingredient, you can say, the main cost of goods, have been totally steady over the last 3 or 4 years, whereas you've had quite a bit of variation in terms of alcohol and spirits during that time, and in terms of beer, it's a difficult situation ahead the way we see it. Wine has not faced that, and that's why we've shown such improvement in our margins over the last couple of years.
I have to ask you this. Let's do a little bit of a SWOT analysis. It's great that you sound so optimistic, so positive. You've got all the opportunities, the strengths. What are the threats or risks that you worry about?
Well, it's not easy. Look, everything that you've said is obviously a challenge, right? So any entrepreneurial journey as well as any corporate journey is full of challenges. Regulatory is a big one. When you talked about the imported wines, Andrew, I didn't answer that. Yes, today you walk into a store, what was called wine shop today. It's really a wine shop. I mean, you just see walls of wines from all over the world. But, you know, I want to point out that we've been building our brand now for 25 years, and that makes a difference. Today, Sula is wine, and wine is Sula for so many people starting to drink wine for the first time and remembering what they drank 10, 20 years ago. We're also bringing out new wines to address people who maybe they want to try something different. Wine drinkers are very adventurous. We're addressing that as well. We also have an imports group, so we do play in that, you know, division as well.
Right.
So, you know, but there's challenges every single day. You wake up and there are challenges. That's what it is, running a business. But we deal with them.
Would you ever acquire a winery from overseas to kind of take you to the real top end? Or I'm just asking.
I think when the time comes,
because Sula is known.
If duties come down further, it's definitely something that we might consider. Right. So it's definitely not off the radar. For today, absolutely not on the radar. If we were looking at an acquisition inorganic, it would probably be in India. But down the road, who knows?
Any
Good question.
Fundraising plans, or this is all going to be internal accruals funding these big dreams?
Right now, we're really looking more at internal accruals. Okay. We have some exciting plans ahead.
So
we didn't
got
talk
free cash flow as well that is sitting on the books.
Yes, I mean our gross margins right now are north of 70%.
Yeah,
so it's a good place to be. You know, having said that, if one of those acquisitions comes along, definitely we would need to probably raise something for that.
So fascinating conversation, very interesting conversation. Rajiv Samant, thank you for coming to the studios. Andrew Holland, thank you for coming to the studios and asking all of these questions. We just want to, yeah, absolutely. And we just want to say very quickly that, of course, we're looking at Sula as a company, as a business. In no way are we encouraging or discouraging the drinking of any kind of alcohol. This is purely looking at it as a business play. We'll slip into a very short break, but on the other side, more conversations coming up. We're speaking with Anil Yadav of IRB Infra Developers, who will tell us about the company's recent order wins and order pipeline. We'll be right back.